So now we're going to look at paper 2017 question 5. This is your interpretation of accounts. So part A, you're required to calculate to 2 decimal places where appropriate the figure for open stock, the rate of stock turnover, return on capital employed, and the period of credit received from trade creditors. 40 marks going just for part A, and there's 100 marks going for all of the question. Okay, so this is very worthwhile. This question comes up every year, always a question 5, so spend a lot of time with this question. If you do, it will ensure that you get a good grade in the exam. And it doesn't vary much. The question is, as I said, it's always question 5, always 100 marks. This question is guaranteed to come up, so make sure you know it inside out. Okay, so the first thing we have to do is find the figure for the opening stock. Now, if you look here, we have our sales, we have our stock and our purchases, which add up to the total cost of sales. Then you take away your closing stock, which gives you your final cost of sales. Okay, so usually when we're going through this, okay, you usually add these two together to get this, and you get this, then you take away this to get your cost of sales. But because we're working backwards, you'll do the opposite. Okay, so what we'll have to do is we'll get the 368,000, add back on the 16,000, and take away this, and this will give us this figure here. Okay, so just to recap, get our cost of sales 368, we'll add back on the 16,000 and take away the 360,000. Okay, so if you're finding this hard to understand the logic behind it, just maybe look to, if in maths, usually if you're going in this kind of linear format, you're adding these and then you're taking this away. Now you're doing the opposite because you're going backwards. So what we'll do is we'll get our cost of sales. So question 5, part A, part 1. So we'll get the cost of sales, which is 368,000. We'll add back on closing stock of 16,000 and take away then the purchases, which is 360,000. Okay. Make sure always use your calculator. Okay, so we have, open my brackets here, 368,000 plus 16,000, close the brackets, take away the purchases of 360,000, and that will give us 24,000 euros. Okay, on to part 2. So we have to get the rate of stock turnover. Okay, so to get the rate of stock turnover, we'll need a couple of things. First, we'll have to get our average stock. Our average stock is our opening stock plus closing stock divided by 2. So you want to find out what is the average stock over the year. Okay, so you get that, get your opening stock, which is here. Okay, we've calculated it in the previous question at 24,000 euros. So let's put it in there, 24,000 euros. And our closing stock. Okay, our closing stock then is 16,000. Okay, so that's our closing stock there. This is our opening stock here. So opening is the 1st of the 1st, closing is always 31st of the 12th. So first thing we'll do is, as I said, is to get our average stock. So average stock is equal to opening plus closing. You divide that by 2 then, which is equal to, so the opening is 24,000 euros. The closing is 16,000. Divide that by 2. Use your fraction button there. 24,000 plus 16,000 divided by 2 is equal to 20,000. So that's the average stock. So then to get the rate of the stock turnover, the formula is, so the rate of stock turnover this is equal to our cost of sales over the average stock. This then is equal to, well, the cost of sales is 368,000. And the average stock, which is here, is over 20,000 euros. So you just key that into your calculator then. $368,000 over 20,000. That's 18.4. So it's 18.4 times. Okay, so on to part 3. So part 3 then is to get the return on capital employed, okay? So to get the return on capital employed, so firstly the formula for that. So the return on capital employed. Basically what this means is, what capital is what you invest in a company. So like for example, if shareholders invest money within a company, they want to see what the return is on it, and employed means what to put in. Okay, so sometimes the language you use can be kind of confusing, but capital is anything you invest in a company. Usually it's cash. What the return they get, so the money you get back, and employed means what to put in. Okay, so the formula for this, again, you have to learn off all these formulas, is net profit plus the interest all over our capital employed. Once you learn off these formulas and understand them, it makes your life much easier, because as I said, like return on capital employed comes up every year, rate of stock turnover comes up quite a bit, like, but there's only maybe a number of formulas they can ask you, like, so I'll actually show you a video on that later on, all the formulas that can be asked in this question. So first thing we want to find is the net profit. Okay, so I can see here the net profit is 171,000. The interest, which I need, again, just look back at my formula, it's net profit plus interest over capital employed. My interest is here. Total interest paid is 8,000. That's it there. And the total capital employed, well, capital and reserves, this is all the capital employed, always. So when you see your capital and reserves, all of these is your capital employed, which is 991,000 euros. Go back to the question here then, my net profit, I just key in the figure, so it's 171,000 euros plus 8,000 interest, all over 991,000 euros. Just again, I'll go through where I got these figures again. So the 171,000, which is the net profit, I got here. Okay, that's the net profit. The interest, 8,000 euros, I got here. And the capital employed, 991,000, I got here. Okay, so just work that out then. So 171,000 euros plus 8,000, all over 991,000 euros. And to change that to decimals, just make sure everyone understands, when you get a fraction like that, this is your standard to decimal button, okay? And that is 0.18. Now, actually, what I should have done here is, I kind of skipped the step, but it should be multiplied by 100 because it's a percentage you're getting, okay? And I'll multiply this by 100. get 18.06 because it asked me to give all my solutions to 2 decimal places. So that's 18.06%. So what's that mean? Well, for the investments or capital that was employed, the investors got 18.06%, which is quite good. So next part of the question, part 4, and it asked me for the period of credit received from trade creditors. Okay, so the credit is it's obviously non-cash and received from your trade creditors. Okay, so they're your suppliers, but you're not paying them cash. So this is the amount of credit you're getting from your suppliers, basically. So again, we have a standard formula for this. Okay, so our trade creditors okay, and we're looking for the period of credit received. So the formula for this is your creditors, again your trade creditors, that's important, over your credit purchases multiply by 365 over 1, because there's 365 days in the year and your answer will be in days then, the period of credit in days that you get. So I'm looking for my creditors, my credit purchases first. Okay, so the creditors then, if I look here, I can see it's 53,000 euros, and the credit purchases then that I have will be 360,000. Okay, so go back to these two figures. I'm looking for my creditors and my credit purchases. The creditors is here in the balance sheet of 53,000 euros, and the credit purchases are 360,000. Okay, so it's substituting those values, so 53,000 euros over 360,000 multiplied by 365 over 1. So 53,000 over 360 multiplied by another fraction, or there's two ways you can do this actually. You can just multiply by 365, or you can do it 365 over 1. It's the same thing. And I get 53.74 because the 6 is after it. You can round up to 53.74. Or you could say 54 days, because essentially that would be 54 days, because you can't really get 53.74. Either answer would be appropriate or accepted. So that's part 1, part 4 and question A. Okay, so just to look again, the 4 things, just to recap what we're asked to do. We're asked to get the figure for open stock. Remember, work backwards. The rate of stock turnover, make sure you get the average stock. The return on capital employed, and the period of credit received from trade creditors, and that's the solutions there. So now on to part B. Explain the following terms and state how they apply to the accounts. First one is the authorized share capital. Okay, so well, firstly, what is that? The authorized share capital is here. Okay, this is authorized, this is issued. Basically what this means is that capital or shares within the company, you can issue shares and investors then can buy these shares, and they get a return in the profits of a company then for whatever shares they have. In this case, we look at the accounts for Goggin Limited, and they have been authorized or allowed to sell shares at €1 each, a total of 900,000. So in other words, 900,000 shares. But so far they've only issued 720,000. So, like for example, when we calculate our capital employed, we look at these two figures here, the 720 and the 171. We don't take this into consideration because this just tells us exactly how much we're allowed to sell. And this is what it has been sold. So, for this question then, so we're on to part B. 1. So you could say is to answer this question, you could say this is the maximum amount of shares maximum amount of shares a company can issue. And remember, issue just basically means what you can more or less sell. In this case, Goggin Limited have been authorized to issue shares at €1 each and 900,000 in total. Okay. This is the maximum amount of shares a company can issue. In this case, Goggin Limited have authorized to issue shares at €1 each and 900,000 in total. Excuse my handwriting; it is kind of awkward having to write on the exam papers, but I'm sure in the exams your handwriting will be much neater. Okay. Now for the second part of the question, it asks us to explain what a trade creditor is. Okay, so a trade creditor basically is someone you purchase goods off of for trade purposes, and that you'll pay back at a later date. So trade creditor in this case, the total is €53,000. Okay. B, part 2. A trade creditor is someone we purchase goods from on credit, and we will pay them at a later date. In this example, the total for trade creditors is, check that again, so our creditors is €53,000. Part C, explain what a liquid asset is and how to apply it in this situation. So firstly, an asset is something you own, okay? Liquid assets are always in your current assets. The reason being is a liquid asset is an asset you want to turn into cash quickly, okay? So if you, for example, if you're having cash flow problems, which given the current climate a lot of businesses may have, you may need to convert your liquid assets into cash, okay? So as I said, it's your current assets. Now, you never include closing stock in your liquid assets. The reason being is that your closing stock, you may not be able to turn into cash quickly. Again, given the current situation at the moment, just say, for example, if you were a automobile parts company, okay, now a lot of people at the moment are spending the money on, you know, food, sanitary products, you know, toilet roll, bread, all these kind of goods at the moment. A lot of customers are spending the money on these type of goods, so they may not have the disposable income to purchase other goods. So that's why your closing stock, you can't always rely on selling this. Okay, as I said, given the current climate as well, it's probably even more relevant. So liquid assets are assets that you can turn to cash quickly. Okay, and they're basically your current assets minus your closing stock. So if I look here, again, we're going with GOG Unlimited. Our current assets are a total of 94,000 euros, okay, including trade debtors, 30,000 euros. But we have to take out our current assets, okay? Our current assets, or sorry, my mistake, our closing stock. So if I look here, our closing stock we've already worked out at 16,000. Okay, so we're going to take that 16,000 away. So liquid assets are your current assets minus closing stock. Okay. They are assets which you can turn into cash quickly. Okay, and in this example, they are sort of current assets. Back here again. Current assets are 94,000 euros. Minus our closing stock, said was 16,000. Equals 78,000 euros. So now on to part C, and we're asked to calculate the asset test ratio for 2016 and have it corrected 2 decimal places. And the second part is, what does the ratio tell us about GOG Unlimited? So the first thing you want to do is the asset test ratio. Okay, so well, what is that? So part C, part 1. So the asset test ratio, so it's a ratio and it's basically your current assets. So let's abbreviate that to CA minus your closing stock. Again, it goes back to what I said a while ago, is that your closing stock, you can't really turn into cash quickly. There's no guarantee, especially if your sales aren't good. It might mean your stock won't sell. To your current liabilities, I'll just put it in CL. So that's your current assets minus your closing stock to your current liabilities. That's the ratio that we have. Okay, now I look here firstly at my current assets. They're 94,000 euros. Okay, my closing stock then is 16,000. So it's going to be 94,000 euro. So 94,000 euros. Minus your closing stock, which you said was 16,000. Okay, and let's put all of that in the bracket there. To your current liabilities. Okay, so if I look at my current liabilities, well, they're my creditors really, and due within 1 year, so it's 53,000. So your current liabilities are obviously liabilities that are due within a year. So that's 53,000 euros. Okay, so 94,000 euros minus 16,000 is equal to 78,000 euros. That's 53,000. Okay, so again, so this is a ratio. If I divide both sides by 53,000, I will get a ratio then, because then this divided by 53,000 will give me 1. Okay, so divide both sides. Let's put my operation here, 53,000 euros. Again, going back to your maths, anything you do one side of the equation, you have to do with the other to balance the equation. So I can't just divide this by 53,000 and leave this alone. So if I get, obviously 53,000 divided by 53,000 will give me 1. And 78,000 divided by 53,000 give me 1.47. Because there's a 1 after that, it'll remain at 7. If, for example, if that was a 5, 6, 7, 8, 9, that would go up to 8, but it's not. So it's going to be 1.47. So 1.47 to 1. Okay, so so we've calculated that. That's part 1. Okay, so just to go back to the question, it just said to calculate the asset test ratio for 16 to 2 decimal places. The second part then is, what does this tell us? Okay, well, see part 2. Well, firstly, the asset test tells us that, you know, for every €1 that we have, okay, we compare it to what we owe. So in this case, our liquid assets for every euro that we owe are 1.47. And in actual fact, what's recommended for this is 1 to 1. So anything above that is good. Okay, anything below that is bad. So in this case, it tells us, this tells us for every €1 that we owe, we have €1.47 in liquid assets. Remember, come back to what is liquid asset? Well, it's something that you can convert into cash quickly to pay your debts in liquid assets. Okay, the recommended ratio is 1 to 1. So this is a good ratio. So last part of the question, part D, it says the return on capital employed for Goggin Limited in 2015 was 16%. Comment on the profitability of Goggin Limited in 2016. Now, if you look previously, we worked out the capital employed at 18.06%. Okay, remember, it's your net profit plus interest over capital employed. So it's 18.06%. Okay, so it's saying here that it was 16%. So it has jumped by 2.06%, which is good. And if you put it in context, you know, so your return on capital employed is what you get back for your investment. If you go into a bank today In 2020, you'd be lucky to get about 0.25%. In 2017, the rate I think was roughly about 0.33%. So in that context, this is an excellent return. So just to write it here, so we said, so part D. Now you can say the ROCE, you can abbreviate like that. In 2015 was 16%, and in 2016 it is 18.06%. Check it again, so you can see here that was the return on capital employed, so it is 18.06%. Sometimes you have to state the obvious here, like, so you know, it has, we know just by looking at it here, you could say, okay, it has jumped by 2.06%, but you still have to write this out. It has increased by 2.06%. The ROC is very good. In a bank, you would expect a return between 0.25% and 0.33%. You just have to give a rough, like I'm being probably too specific here, but just know it's around 0.3% in the exam. This is a very good return. Okay, so that's question 5. As I said, comes up every year. This really should be your starting point almost going into the exam. I will put up a video later on of showing all the formulas that you need. But as I said, every year, question 5, this comes up. There's only so many ratios they can ask, and so many definitions they can ask as well. If I just say go back, for example, just look here at the analysis of the papers. See here, since 2005 up to 2009, look at this. Every year it comes up, and it's worth 100 marks. Very, very doable question. Make sure once you can do 2 or 3 of these pretty good, then you can do all of them. So spend a lot of time at this question. It will pay off, and you should be looking to get between 80 to 100 marks in this.